Hi class, today we're going to be looking at a new chapter. We're going to skip chapter 5 and we're going to go into chapter 6. And so what we want to talk about today are a merchandising business and how to record purchase transactions. So if you'll hold on with me just a minute, I'm going to share some notes with you today. And so you should be able to see my notes right now. First of all, what I need to tell you is what a merchandising business is. In a merchandising business, what we're going to be doing is we're going to be buying merchandise, and then we're going to turn around and sell this merchandise for a profit. This business is a little bit different than what you've been used to doing. In chapters 1 through 4, we covered a service business, and a service business provides a service to customers to earn a profit. So in this particular chapter, we're going to be working with merchandising businesses where we are going to be buying merchandise to resell to our customers. And there are some differences between a service business and a merchandising business. And the differences are reflected in what we call the operating cycle and the financial statements of the business. The operating cycle for a merchandising business is the time that it takes for us to buy merchandise, put it in our store, sell the merchandise, and collect cash from that sale. So there's an extra step in the operating cycle for a merchandising form of business. We've got to buy merchandise, and then we're going to sell it to earn a profit. The main differences are going to be in your financial statements, and in particular, our income statement is going to be a little bit different. So what I've done is I've set up a form of the income statement that you're already familiar with for a service business. In a service business, we usually start with our revenues, an example of revenues would be fees earned for a service business. And then we're going to subtract out our expenses. And the expenses could be any expenses that that business has incurred for a period of time. Remember, we match our expenses with our revenues to give us our profit for that period of time. Now we're calling it the income from operations, but basically revenues less expenses is still going to give you net income. We just changed the name around a little bit. For a merchandising business, notice that we have a little bit more account titles associated with that. What we will be preparing for a merchandising business is a multi-step form of an income statement. So our income statement is going to change a little bit. We're still going to start with our revenues, but our revenues are now going to be called sales. In a merchandising business, we're going to be selling our merchandise inventory to make a profit. So sales is going to be our revenue account. And just like any revenue account, sales is going to increase on the credit side. So the things that you learned in chapters 1 through 4 are going to still hold true for this chapter. What we're doing in this chapter is we're just adding some more information to what you already know. And you remember in chapters 1 through 4, we always prepared financial statements, and we always started with the income statement. And this is no different. We're going to start with an income statement as our financial statements. We need to determine the net income because it's going to go into the statement of owner's equity. And then the ending owner's equity will feed into the balance sheet just like it did before in chapters 1 through 4. So for an income statement that we're preparing for a merchandising business, we're going to start with sales. Sales is our revenue account. Notice there's a new account that's on here called cost of merchandise sold. And that's exactly what it says it is. When we buy the merchandise inventory to sell to our customers in a merchandising business, the cost of that merchandise, what we had to pay for that merchandise, is what we consider to be cost of merchandise sold. And cost of merchandise sold is an expense account. So cost of merchandise sold will increase on the debit side because it is an expense account. And cost of merchandise sold is recorded on the income statement. Now there's a new line that we need to talk about, which is called gross profit. And gross profit is just a category. It's not an account that you're going to find in your ledger. Your sales account and your cost of merchandise sold, you will find in your ledger accounts. But gross profit is just a subtitle. And this gross profit is found by subtracting the cost of merchandise sold from our revenue. That will give us our gross profit. What gross profit is the profit that we have to cover our operating expenses. So you'll notice the next category, I've got to subtract out your operating expenses. Now, something you need to know about operating expenses is that they're broken down into two categories. One is a selling expense category, and the other is an administrative expense category. Your selling expenses are going to relate to the sales of the product. All the expenses that relate to the sales of the product will be selling expenses. So things like advertising expense, sales salary expense, you could have depreciation expense on your selling equipment. Any type of store related expense will go into the selling expense category. Your other type of expense that is a part of operating expenses are administrative expenses. And your administrative expenses are your expenses that are the general expenses that your company incurs. Like you could have insurance expense, or it could be expenses that relate to the office. So if you had some office salaries expense, that would be an administrative type of an expense. So we have selling expenses and administrative expenses that make up the operating expenses, and the total of our operating expenses are going to be deducted from the gross profit, and what's left over is what we consider to be income from operations. Now, there's a little bit more to this multi-step income statement than just what I'm showing you here. Mainly today, we just want to concentrate on the fact that there are differences between a service business income statement and an income statement for a merchandising business. Notice I have written in bold the statement of owner's equity for a proprietorship form of business. That's a one owner. We're still talking about a one owner type of business in this class. In fact, all of ACC 120, we're just going to talk about one owner types of businesses. But the statement of owner's equity is the same for a service business as it is for a merchandising business. It doesn't change in format. You'll still have beginning owner's equity. You'll add to it your owner's investments. You'll add to it your net income for the period, or you'll deduct from it the loss for the period, depending on what you had. And you will still subtract out your withdrawals to get your ending owner's equity. The statement of owner's equity doesn't change. And so we're not going to see that emphasized a whole lot in this chapter. I just want you to know that it stays basically the same as it did for a service business. And the balance sheet, when we prepare it, it stays basically the same in format, but there's just going to be some new accounts that we're going to introduce in this chapter that we're going to be adding to our balance sheet. And one of those accounts I'm going to introduce to you today, and the other accounts are going to come as we go through this particular chapter. The main type of balance sheet account that I want to talk to you about today is your merchandise inventory account. Merchandise inventory, of course, is the merchandise that you're going to purchase to resell to a customer. Merchandise inventory is a current asset. So merchandise inventory is going to be found in the current asset sections of the balance sheet. Merchandise inventory, what you have left over of that merchandise inventory that you have not sold, will be found on the balance sheet. The ending amount of merchandise inventory goes on the balance sheet. The part that you sold goes into the cost of merchandise sold. So merchandise inventory is going to be debited or added to when the merchandise is bought to sell to customers. It will be credited when the merchandise is actually sold in a perpetual inventory system. And what a perpetual inventory system is, it's a type of inventory system where we keep a record of all the inventory that we purchased during a time period and all the inventory that we sold during a time period. So we know how much inventory we have on hand all throughout the time period. So a perpetual inventory system keeps a record of the merchandise that you buy and you sell on a continuous basis. At all times, we know how much inventory that we have. Now, in your textbook, they mention a periodic inventory system, but most companies now use a perpetual inventory system. So we're going to concentrate on the perpetual inventory system. We may talk a little bit about the periodic inventory system a little bit later on, but for today, I want you to realize, or want you to be able to recognize what a perpetual inventory system is and what it does. It keeps a record of all the merchandise that we purchased and we sold on a continuous basis. So at all times, we should know how much inventory that we have on hand. Now, what we're going to do for the remainder of this video is talk about purchase types of transactions. In this chapter, there will be purchase transactions and there'll be sales transactions. We're going to concentrate on just the purchase transactions today. And so because we buy merchandise to resell to our customers to earn a profit in a merchandising business, we're going to either sell that merchandise for cash or we're going to sell it on account. We're also going to be buying the merchandise either for cash or on account. So in the transactions that we're going to talk about today, they're going to be purchase related transactions. So we're going to talk about when retailers or merchandising businesses buy merchandise for cash or they buy it on credit with accounts payable. So if you buy it with cash, your cash purchases are documented with purchase receipts. Purchases of merchandise on account or on credit are documented with purchase invoices. And purchase invoices contain information about the purchase transaction that is needed for you to record purchase transactions properly. And in your book, and I just copied this out of your book, is a example of a purchase invoice. This purchase invoice is from the Alpha Technologies company. We're going to be Net Solutions, so we're buying from the Alpha Alpha Technologies company. And notice that the invoice that they have sent us is numbered. All invoices usually have some type of numbering system on them. And so this one is no different, it's numbered. On the purchase invoice, it should have who the merchandise was sold to. Again, we're going to be the Net Solutions company. We're buying from Alpha Technologies. So Alpha Technologies would send us this invoice with information about our purchase on it. And see here that they had a customer order number of 412. And that might have been a purchase order that was sent to Alpha Technologies by Net Solutions to say, hey, we'd like to buy some merchandise from you. This is the order number that they gave us. Or it might be the order number that we sent them. The order date was January the 3rd. Now, what's important on this purchase type of invoice is some information that is on this line here. First of all, they're telling you that they are shipping this information, this merchandise that we bought from them to us. So notice they've got some information about how it was shipped. They're going to be shipping it through U.S. Express Trucking Company. That's the name of the shipper. And it's going to be coming from San Jose, which is where the purchaser, which is where the seller was located. And it's going to be sent to Cincinnati, which is where we as the buyer are going to be located. Notice there's some terms on here that says FOB. Those letters stand for free on board. But really, these are shipping terms and there's nothing free on board. Sometimes it's referred to as freight on board, and I think that's probably a more appropriate name for it. There are going to be shipping terms when we have bought merchandise from a supplier that's in a different location than we are. So it's important to pay attention to the shipping terms because they tell us what we need to write down in our transactions. And basically, there are 3 types of shipping terms. And let me start with FOB since it's first here. And you see I've got an arrow drawn over here to explain what those terms mean. FOB is a category of shipping terms. If these shipping terms said that this was FOB shipping point, notice it doesn't say that here, it just says that it was shipped. But if these had said FOB shipping point, what that tells us is that it means that the buyer, the purchaser, which would be Net Solutions in this case, is going to be willing to pay the shipping. And the purchaser, which would be Net Solutions, would be adding the shipping to the cost of the merchandise inventory. So if we had terms here that said that it was FOB shipping point, then we know from that term that the buyer is willing to pay the shipping and the buyer is just going to add it back to the cost of the merchandise inventory. So what they're going to end up doing is debiting the merchandise inventory for the amount of the shipping. The buyer debits the merchandise inventory if it's FOB shipping point. If the term said FOB destination, that means something totally different. That means that the seller, which would be Alpha Solutions or Alpha Technologies, would be willing to pay for this shipping. So if it's FOB destination, if this had said FOB destination here, the seller pays the shipping charges and the account that the seller uses is a debit to delivery expense, and this delivery expense would be recorded on the seller's books. So if the terms are FOB shipping point, the purchaser pays, and the purchaser records the shipping on their books. If the terms are FOB destination, the seller pays, and the seller records the shipping on their books. The third type of shipping is something that could arise, it not always does, but it could arise if the seller prepays the shipping as a courtesy to the buyer. They prepay the shipping. In other words, they're going to pay the freight carrier as a courtesy to the buyer. Usually, if the seller pays for the shipping as a courtesy to the buyer, those shipping charges would be added back to the buyer's invoice. So in other words, the buyer still is going to pay the shipping eventually, but the selling company pays the actual shipper itself. Then the buyer will reimburse the seller for paying the shipping charges for them as a courtesy to them. So there could be this third type of shipping terms, whereas a courtesy to the buyer, the seller prepays the freight and adds it back to the invoice of the buyer. So the buyer ends up paying the shipping when the invoice is due, and they pay it to the seller because the seller has already prepaid the shipper for that those shipping terms. So it's important that you know information that goes on the purchase invoice. The next type of information that we're going to look at is what we call the credit terms. Notice here they've got a 2/10. What that stands for is that this supplier, this Alpha Technologies, is offering Net Solutions a discount if they pay them within 10 days. The amount of that discount is 2%. So 2 stands for percent. 2%/10 days is what the purchase discount amount would amount to. So in other words, if Net Solutions pays within 10 days of the invoice date, they can take a 2% discount off of their purchase. Now, sometimes the terms will be 110 or 115, or it could be anything that the supplier comes up with. But a lot of cases, it's just going to be 210 to keep things simple. So 2% discount is offered if paid within 10 days. Notice there's a comma there, and then there's an N that stands for the net amount is due in 30 days. That /30 means that the full amount has to be paid in 30 days. But if the buyer pays within 10 days, they get a 2% discount. If they don't pay within 10 days, they have to pay the full amount of the invoice in 30 days. So the terms are very important here. And these are what we call credit terms. Now, sometimes what the terms will say, it might say cash or COD, cash on delivery. And in that case, what that would mean is that the cash amount has to be paid by the terms of the invoice. And it's expected on the delivery date. But mainly these are credit terms, and they're allowing you to know that you've got some time that you're going to be able to pay for those merchandise, that merchandise that you purchased to resale in your business. So the credit terms are very important. The credit terms are associated with the invoice date. So January 5th is the invoice date. As long as we pay within 10 days, we can take a 2% discount off of this total amount that we owe of $3,000. If we don't pay by January the 15th, the net amount is due in 30 days, 30 days from January the 5th. Now, sometimes these can say NEOM, which is net end of the month. So just pay attention to what the terms of the invoice are, because they're going to dictate to you how you record your transactions. So these terms are very important here. Another term that you're going to run into on your homework problem that we're going to discuss in just a minute is list price. And list price is a sticker price, or sometimes it's called the catalog price, that a wholesaler would offer to a buyer. So when we're buying merchandise inventory, sometimes we'll go to a wholesaler to buy our merchandise inventory so that we can turn around and sell it to our customers. Buyers rarely ever pay this list price. It's just basically an amount to go by. They usually are offered some type of discount with the list price, and sometimes those discounts are what we refer to as trade discounts. And trade discounts are offered by wholesalers for a quantity of inventory that's purchased in bulk. So if we buy a whole lot of inventory from a wholesaler, they're probably going to allow us some type of trade discount. Trade discounts are recorded at the purchase price. And to find the purchase price, we would take the list price and subtract the trade discount from it. And that will give us the purchase price. Sometimes they refer to that as the net purchase price, but technically the net price could also involve credit terms that are associated on the invoice, like the ones that we just saw here. So sometimes you can have a trade discount as well as a purchase discount. Take the trade discount off the list price first, and then apply the purchases discount to that. And we're going to be doing some transactions like that, if not today, certainly in the future in this chapter. So those are the terms that I want to talk to you about. Now I'd like to go ahead and start a problem with you that will be similar to your homework problem. And so I'm going to stop sharing this for just a second because I need to pull up another spreadsheet with the information on it about that next problem. So hold on with me. I'm going to try to do this as best that I can. Okay, it's not showing you that video, so I'm going to stop sharing this for just a minute. I'm going to pause for just a minute and I'm going to see what's wrong. Hang on. I'll be back in just a second. I'm going to try it with you again, so hang on just a second. Okay, I think you can see it now. And so we're ready to start chapter 6, problem 1B. And these are going to be all purchase related transactions. So we're going to be buying merchandise inventory in these transactions. The following selected transactions were completed by the Niles Company during March of the current year. So these are our transactions, and we're going to put them into the journal. So on March the 1st, it says that we purchased merchandise from Haas Company for $43,250. The terms were FOB shipping point. What FOB shipping point means is the buyer is going to pay the shipping. Since we're the buyer, we're the Niles Company, we're going to be the buyer in this situation, we're going to pay the shipping charges. The invoice comes with terms. The terms are 210, comma, net end of the month. So 2/10 represents the discount that we will be offered. We are offered a 2% discount if we pay within 10 days of our purchase date or of our invoice, which is March the 1st, is when we're going to be receiving the invoice for this transaction. So if we pay by March the 10th, we will get a 2% discount. If we don't pay by March the 10th, the full amount of this invoice, which this is your gross amount right here, is got to be paid by the end of the month. Notice they've got out here to the side that there's some prepaid freight of $650 that was added to the invoice. Remember when we talked about shipping terms just a few minutes ago, we said that there was a third type of shipping term where the supplier offers to pay the shipping to the shipping company for us, but they're going to add it back to our invoice. This is a situation where that has actually happened. So there's several things that are going on in this first transaction. First of all, this is the gross amount of the purchase. But if we are offered a discount, we're going to record our purchase transactions always at the net purchases amount. That means we're going to take advantage of all discounts that we're given. And in this chapter, anytime a supplier offers a discount, the customer is going to take advantage of that discount. The net amount is what they're going to be paying. And so they're going to record this transaction at the net amount. Notice that we're buying merchandise inventory. The account that we would debit here is merchandise inventory. Remember, merchandise inventory is a current asset, and my assets are increasing when I buy merchandise inventory. I am buying merchandise inventory so I can resell this merchandise or I can sell this merchandise to a customer for cash or on account. So we're not selling in this transaction, we're just buying the merchandise so we'll have it in our store and ready to be able to sell to our customers. So when we buy merchandise, our merchandise inventory account, which is an asset, is going up. We're going to increase the asset by the net amount of the purchase. Notice this is not $43,250. What this amount reflects is the gross amount of the purchase, which was $43,250, times the net amount of the discount. So if the discount is 2%, then we're really paying 98% of the purchase price there. So all I did is I subtracted 2% from 100%, and that gives me 98%. We're paying 98% of this original gross price, but because the seller prepaid the shipping for us, and we had agreed with FOB Shipping Point that as the buyer, we would be paying the shipping, they added it back to our invoice. So the total amount that we owe to the Haas company is $43,035. These are my computations as to how I got the debit amount here. Notice I've credited accounts payable because anytime there are terms like this, these are credit terms. You have a period of time to be able to pay back this company that you bought the merchandise inventory from. So it's got to be on credit here. So all of the purchases will be made on credit unless they state otherwise. So we're buying this merchandise on credit. Notice out to the side of accounts payable now, I have written Haas Company. You remember that I said that we skipped chapter 5, and in chapter 5, it was about showing how much we owe to our suppliers. So accounts payable is made up of all the creditors that we owe money to. One of our creditors is going to be the Haas company. So we want to record how much we owe to the Haas company. This Haas company account will be kept up in what we call a subsidiary ledger. A subsidiary ledger is an extra book, it's an extra ledger that goes with the general ledger that backs up information in the general ledger. In our general ledger, we're going to have the accounts payable account. But in our subsidiary ledger, we're going to keep a record of all the creditors that we owe money to. So the Haas company is going to be located in the subsidiary ledger. The amount that we owe Haas company is 43,035. We would want to know as a company how much we owe to our creditors and who our creditors are. So it's kept up in a separate book that we call a subsidiary ledger. So I thought I would just throw that in at you. So when we purchase transactions, when we're buying merchandise, we're going to debit merchandise inventory, and we're going to credit accounts payable and put out to the side of it the supplier that we owe the money to. In this case, it was Haas company. And I just wrote the computations down here so you could see how I got this amount. In the March 5th transaction, again, we're purchasing merchandise, but this time we're buying it from the Whitman company. So you see how we're debiting merchandise inventory because our asset merchandise inventory is going up. We're crediting accounts payable because our liabilities are also going up. But notice out to the side here, I've got the supplier name. Our supplier name was Whitman Company. Notice on this transaction, the gross amount is $19,175. The terms were FOB destination. These are our shipping terms. If it's FOB destination, it means the seller has agreed to pay the shipping. So that will not be reflected in our books at all because we're going to be the purchaser. Notice the terms are we have 30 days to pay this amount. They did not give us a discount. If they had, they would write like 2/10 or 1-15, net 30. In this case, there's no discount that's offered. So we have to pay the full amount in 30 days. So this is the full amount that would be debited to the merchandise inventory account. Merchandise inventory is increased because it is an asset account, and we're going to credit this account to the liability account. On the 10th, we paid the Haas company the invoice of March 1st. Notice that's exactly 10 days later. So we took the discount and we had to pay back the freight because it was prepaid for us by the seller. So what we're doing is we're reducing their accounts payable in the March 1st transaction by debiting it, and we're crediting cash for the total amount that we owed, which was $43,035. $43,035. On the 13th, we bought merchandise again from the Joss company, $15,550. The terms were FOB destination. That means the seller pays. We're not going to have to worry about any shipping. They offered us this time a 2% discount. So we're buying the merchandise. Our merchandise inventory has to be debited. Our accounts payable is going to be credited for the Joss company. And what we're going to do is we're going to take that $15,550 and multiply that by 98% to get the net amount that we are going to record for this purchase of merchandise inventory. So 15,550 times 98% gives you 15,239 that we would debit to merchandise inventory because our assets are increasing, and we will credit to accounts payable because our liabilities are increasing. Now, notice what happens on the 14th. We are issuing what we call a debit memo. I need to talk to you about a debit memo. A debit memo is just saying to the company that we bought the merchandise from, which was a Josh company, that we're sending some merchandise back. The merchandise gross amount that we're sending back is $37.50, and we're returning it from the March 13th transaction. So if you want to look back at the March 13th transaction, you can see that we were offered a discount. So we recorded it at the net amount on our books right here. So what we have to do is when we take some merchandise back, which is what we're doing here, we're returning some merchandise that we purchased to the Josh company. We got to take that discount back off of the gross amount, which was $37.50. So $37.50 times 98% gives you the net amount that was originally recorded in this transaction here. So we got to reduce our accounts payable by that net amount there. We would reduce our merchandise inventory. To reduce accounts payable, we debit. To reduce merchandise inventory, we would credit because merchandise inventory is an asset, accounts payable is a liability. You're reducing both of these accounts because you sent back some of the merchandise inventory that you originally purchased here. You no longer owe for that merchandise. And you'll send them a note with that, which we call a debit memo. That's just a source document, a piece of paper that would go with the merchandise that we send back to them to notify them that we're not keeping that merchandise. On the first 18th, we purchased merchandise from the Fairhurst Company for $13,560. The terms were FOB shipping point. That means we're the buyer. We're going to be paying the shipping. There were no purchases discounts offered to us. The net amount has to be paid by the end of the month. EOM stands for end of the month. So since there were no discounts that were offered to us, the full amount, the gross amount, is what we're going to record as a debit to our merchandise inventory. So our merchandise inventory is debited for $13,560. We've got a credit to accounts payable and the Fairhouse Company that goes in the subsidiary, the accounts payable subsidiary, at $13,560. On the second 18th, we paid freight charges of $140 on the March 18th purchase from the Fairhouse Company. So remember, on the first March 18th, it says it was FOB shipping point. That means that we have to pay the freight. So we're paying the freight carrier. And what we do, if it's FOB shipping point, listen closely here, we're going to add it back to the cost of our merchandise inventory. We're going to credit our cash because we're paying the shipping company. The amount of the shipping was $140. So this merchandise inventory is going to be debited because shipping costs add to the cost of the merchandise inventory. And so merchandise inventory can be debited for the purchase. They can also be debited for the shipping cost if the terms are FOB shipping point. So we paid the freight of $140. And this was the transaction where we did that. We debited merchandise inventory and credited cash for $140. Moving on to the 19th, we are buying merchandise from the Bickle Company, $6,500. Terms were FOB destination. That means the seller is going to pay. Doesn't have anything to do with us as the buyer, but the seller has offered us a 2% discount. So we're going to take the $6,500 and multiply it by 98%, and that will give us $63.70, which we debit to the merchandise inventory and credit to accounts payable. On the 23rd, we paid the Joss Company for the invoice of March 13th, less what we returned from the debit memo on March the 14th. So this one is going to take into consideration March 13th and the 14th. Notice that the accounts payable was credited on March 13th for the amount we purchased, and then we debited it for the return of that merchandise. So the difference between these is the amount that we owe to the Joss Company. So we're going to end up debiting the Joss Company for the amount that we owe, which was $15,239 less the return of $3,675. That gives us the amount of cash that we're going to pay to the Joss Company. Our accounts payable is reduced to zero by debiting $11,564, and then we are going to credit our cash account for $11,564. We're paying the Joss Company the amount that we owed him less the return, which was $11,564. On March 29th, we paid the Bickle Company for the invoice of March the 19th. So we got to go back to the March 19th transaction to see how much we owed the Bickle Company, which was $63.70. So what we're doing is we're reducing this accounts payable down by $63.70. We're going to debit our accounts payable to reduce it, and we're going to credit our cash because we paid the Bickle Company. On the 31st, we paid the Fairhurst Company for the invoice of March the 18th. So we go back to March 18th and we pick up the amount of the invoice, which was $13,560. You can refer back to this transaction right here where we've got a credit to accounts payable. We're paying this company off, so we're going to debit this for $13,560 to the Fairhurst Company, and we're going to credit our cash account. And then on the last 31st, we paid the Whitman Company for the invoice of March the 5th. And so we're going to go all the way back to the March 5th transaction. We owed $19,175. So we're going to debit our accounts payable for $19,175 and credit our cash account for $19,175. So the only thing they wanted you to do in this problem was to record the transactions through the journal, and this is what would have happened. So I'm going to stop sharing this with you, and I'll see you again next time. Bye-bye.